Take a look around the retail trading space today. Honestly, it feels way more like a chaotic casino than a functioning financial market, doesn't it? It's heavily gamified, it's super high anxiety, and it seems entirely obsessed with zero-day options and chasing overnight meme stock riches. I mean, just imagine the sheer stress of refreshing your portfolio 50 times a day, your heart pounding, just praying a volatile stock swings your way before the closing bell. But what if the real secret to long-term market success isn't flashy at all? What if the absolute best antidote to all that noise is actually an approach that prides itself on being proudly, aggressively boring? In this explainer, we're going to unpack the underlying philosophy behind expired options. It's a strategy that deliberately turns down the volume, blocks out the hype, and focuses entirely on the quiet, methodical grind of sustainable wealth building.
So let's break down this massive contrast right off the bat. On one side, you've got the high-voltage world of modern speculative finance. People are constantly chasing gross premium, maxing out their margin accounts, and gambling on unpredictable quarterly earnings. Let's be real, that is a fast track to total burnout. But on the other side, we have the methodical, spreadsheet-heavy reality of the expired options approach. This isn't about the thrill of the trade or getting a quick dopamine hit. It's about a calculated, slow and steady grind that relies on math, incredible patience, and actual, tangible stock ownership over the long haul.
To see how this system actually ticks, we're going to reverse engineer the whole thing, step by step. We'll hit 1. The aggressively boring edge, 2. The buy and hold foundation, 3. Leaps as trial periods, 4. Margin-free risk management, and 5. Intellectually honest performance.
Kicking things off with Part 1, the aggressively boring edge. We really need to pin down exactly who this methodology is for, because it is definitely not for everyone.
The target baseline number here is highly specific, $25,000 to $50,000. The expired options strategy is literally built for retail investors who've put in this serious sweat equity to save up a meaningful chunk of capital, and they're just completely exhausted by get-rich-quick nonsense. And why does this specific number matter so much? Because if you've painstakingly built up a 30-grand portfolio from your own savings, losing it would be absolutely devastating. At this level, your whole mindset has to pivot from reckless gambling to wealth preservation. You don't want to blow it on a whim, right? You want a sustainable path to grow that money, generate a little premium, and systematically build your stock positions without risking total ruin.
So, once that capital is saved and the mindset is locked in, how do we deploy it? That brings us to Part 2, the buy and hold foundation.
The absolute biggest takeaway here is that this is not some rapid-fire options trading scheme. It is, fundamentally, a long-term stock ownership portfolio that just happens to be enhanced by options. They stick to very conservative strategies. We're talking cash-secured puts with a 0.10 to 0.20 delta, so roughly just a 10 to 20% implied probability of actually being assigned the shares. And here's the kicker. They selectively sell these puts specifically on down days. Why do that? Well, when the market is bleeding red, fear takes over and implied volatility spikes. That fear makes option premiums way richer, letting you collect more cash while potentially snapping up a stock at a steep discount. On the flip side, they sell low-delta covered calls against their existing shares specifically on up days, when greed is driving call premiums up. The ultimate goal is to safely generate extra income without accidentally getting those high-quality core shares called away during a massive rally. In this system, the options always serve the stock portfolio, never the other way around.
Which leads us to what I think is the most innovative part of the whole strategy, Part 3, leaps as trial periods.
Now, as a quick refresher, LEAPs are long-term equity anticipation securities. Basically, they're just options contracts that expire more than a year out in the future. Retail traders often totally abuse LEAPs. They treat them like lottery tickets, using them to get massive, cheap leverage on ultra-speculative meme stocks. And, that usually ends in tears in a blown-up account when the market inevitably turns against them. But the expired options approach takes this exact same instrument and does the exact opposite.
They have this brilliant way of viewing LEAPs as, quote, a trial period for long-term equity exposure. What does that mean in real life? It's all about capital efficiency. Instead of blindly dropping tens of thousands of dollars to buy 100 shares of a company they're just starting to research, they use a LEAPs contract to literally test drive the stock. Controlling 100 shares via LEAPs costs a mere fraction of buying the shares outright. That keeps the vast majority of your cash safely chilling in your account, earning interest, and totally out of harm's way. Here is exactly how that methodical life cycle plays out. Step 1, buy a deep in-the-money LEAPs contract, targeting around a 0.70 delta. Put simply, a 0.70 delta means the options price will move roughly 70 cents for every single dollar the underlying stock moves. It closely mimics owning the actual stock, but requires way less capital up front. Step 2, hold it for a year or more. During this time, they patiently evaluate the company's earnings, watch how management executes, and really gauge their own conviction in the business. There are no rigid, high-stress mechanical rules forcing them to roll the option at 90 days. It's a pure, fundamental evaluation. Finally, step 3, as expiration approaches, if they love the company, they simply exercise the option and take the shares. If the thesis changed, they close it out and walk away. It's an incredibly disciplined, practically stress-free way to build a portfolio. But look, none of these trial periods matter if one bad month wipes you out. Enter Part 4, Margin-Free Risk Management.
The expired option system is governed by a genuinely ruthless risk framework. The non-negotiables are crystal clear. 0 margin allowed, 0 naked options. Every single option sold is either fully backed by cash in the account or covered by shares they already own. Plus, they completely avoid opening short options right before binary events, stuff like quarterly earnings or major Fed announcements. Why? Because earnings are a binary event. They beat or they miss. Before the news, uncertainty is huge, so premiums inflate. But the second that news drops, the uncertainty vanishes and those inflated prices collapse. It's a classic implied volatility crush. The extra premium you grab up front just isn't worth the severe risk of a massive price gap. They flat out refuse to take on that kind of unlimited risk.
And this sizing rule right here is the ultimate sleep-at-night metric. Before hitting buy, you ask one simple question. If assigned, can I comfortably manage the resulting position without using any margin? Think about what happens during a correlated market sell-off, where absolutely everything tanks 20% at once. Traders loaded up on leverage get slammed with margin calls and lose everything. But because this portfolio is sized entirely on the obligation of assignment, it's structurally built to absorb those exact panic events. A 20% market crash isn't a liquidation event, it's just a temporary dip that you can patiently ride out.
And that brings us to our final pillar, Part 5, Intellectually Honest Performance.
Spend 5 minutes on any trading forum and you'll see people flexing about how much premium they collected this week. But bragging about gross premium is a complete vanity metric. It means literally nothing if you have to buy that option back for a massive loss a week later. Expired options draws a hard, uncompromising line between premium collected and actual, realized profit and loss once a position is closed or expires. In the aggressively boring world, cold, hard reality is the only metric that actually pays the bills.
And the way they benchmark that reality is crucial. They hold their portfolio to the highest standard possible by comparing it directly against the S&P 500 Total Return Index. They carefully factor in reinvested dividends to make sure it is a perfectly fair fight. But arguably most importantly, they strictly isolate out new capital deposits. So many casual traders trick themselves into thinking they're market geniuses just because they auto-deposit part of their paycheck every 2 weeks, making their balance go up. The expired options portfolio adds about $600 a week in new savings. If you lump that into your percentage returns, you're totally inflating your success. Stripping out those deposits and going head-to-head against the S&P total return is the absolute, undeniable proof of whether all this active management is actually worth your time.
Which leaves us with this final, stark question to ask yourself the next time you log into your brokerage account. Are you trading just for the entertainment, constantly chasing the high of a speculative gamble? Or are you truly investing for long-term wealth? The expired options framework makes a pretty compelling case that adopting a proudly, aggressively boring, mathematically honest, and margin-free approach isn't just safer. It might literally be the most reliable edge a retail investor can have. Take a hard look at your own strategy today and ask yourself which side of that line you're really on.